It's been a wild ride doing this summit. Thank you for enduring. My wife commonly says, living with me, which we've been married for almost 17 years actually, that she gets seasick. Because it's just a little bit of a wild ride. We're starting this business. We bought that property yesterday. We're doing this, or we did that 6 months ago. Why didn't we didn't talk about that? What? It happened. Now we're not doing it anymore. So, but here we are. It's been a great ride. And I would like to actually, selfishly, I apologize. Great panel. I won't take too much more time. These guys have a lot to say. My wife, Christina Bond, right over here. Stand up. This is awkward. She's going to hate me for this. And my son, Henry Bond. What everybody? Is one of 4 sons and 1 daughter. So we have 5 kids. Henry wanted to come up every morning when I was getting here between 6 and 7, was like, oh, I want to go with you then. And I'm like, no, like sleep, be a kid. Come when mom comes. And he really wanted to come, and I didn't let him, sorry. Okay, so here's how we're going to do this. The purpose of this session is markets shift. I've explained it when I've been in residential real estate, when I've talked to investors. It's healthy. It is good for markets to ebb, flow. It's a living being is how I think of it, that the market breathes like our lungs, expands, contracts. And that's normal, it's healthy, it's good. People freak out in market shifts. They get excited when everyone's excited and they spend their money, and that last group always ends up holding the bag because they do it dumb because they're doing it like candy and they forget the meat. Raise your hand if you got a little bit of meat this weekend. Yeah, helpful, like factual, knowledgeable information, practical advice that you can actually do. Sure, there was some motivational stuff, and that's good, but there's meat and action and things that should take place. So when the market does this and corrects, which doesn't always mean a crash unless you got 100% financing and you live paycheck to paycheck, and now it is a crash to you. Thank you. I don't know where that was, but thank you. Yeah, Matt, thank you. Then it's a crash. If you're not doing that and you're planning, it's an opportunity. The corrections are where the wealth is really, really created, because those who think, plan, and execute dominate in corrections. That is your panel. People that have done that. And I know, and I'm so excited to hear how they're making their plans going into this next breathing exercise that the market will do. So that's what we're going to do. I'm going to give them all an opportunity for we're going to call it a 1 minute. We all know that they have things to say. They're going to turn it into 3, maybe 5. But you have a minute, right? No one has a timer, though. Who you are, what your quick background is, and what your plan is going into a market shift, whatever you think the future is. And just tell us what your current specialty is and what you're going to do. So we're going to start with, no, I won't do it. Okay, we're going to start with Mike. So there's a picture.
I'm giving everyone exposure.
Oh yeah, there you go. We're going live. Is this live?
Yeah, you're live.
Man, this is, how many people? No, I'm just kidding. Don't do that. Okay, so we're going to start with Michael Bingham. We're going to go over this way. There's a mic per table. We haven't covered logistics. Everyone, sorry, we're doing it now. Should be live. Mic's tested. Awesome. Go right ahead.
Okay. Mike Bingham, Blue Diamond Capital. I don't know what our specialty is, probably multifamily and hospitality in the Intermountain West. And what are we doing to prepare for this downturn? I think probably more than ever, we're looking into the details. We're just digging in. I think more than ever, leading up to something bad, you need to know how you are positioned against everybody else. And quality is key when there's a downturn.
Grant Collard. I'm with Redstone Residential. We're a student housing investor and operator based here in Provo, Utah. Have about 27,000 beds of student housing around the country, but we're mostly a Western U.S. focus. In terms of the downturn, we're kind of, I mean, it sounds morbid. We're we're kind of excited, right? We're kind of cheering for it. Student housing as an asset class is typically a little bit more countercyclical. We see behavior where people are actually going back to school, and we see enrollments go up, we see occupancies go up. But preparing for it, we're just making sure that we execute on super high quality deals, that we're not building unrealistic assumptions into our models and our budgets when we buy. We've actually been levering down a little bit in our new acquisitions rather than topping off at the highest LTVs that we can, maybe going a little bit more moderate, and just stress testing our new deals to make sure that we won't have any issues should anything pop up.
This is going to be good.
I'm Mike Miller with FIG. I just say, Steve and James, what do you think we should do now? No, I think most of our pressure comes from competition in the retail single-family home market with our townhome products, and so what we've done is we started here in Utah, and the market pressure that we feel is from competition, not in sales really, but in subs, land prices, commodities. And so we have spread our market, so we've made the market bigger. And then that would help the pressure on one single market in a downturn. And we're continuing to grow. So we're in 3 markets now, and it'll be 5 by the end of the year.
Dave Allred, worked for Vivint Solar the last 17 years, and currently the founder of the Golf Club, which is a venue similar to Topgolf we're bringing into Utah County. And the biggest thing that I'm doing to prepare for future market adjustments would be, one is maintaining liquidity. The largest risk with my multifamily portfolio and watching other investors has been when there's a lack of liquidity in a downturn, right? There's not been a time when over a 5-year period where values have dropped and stayed below where they were 5 years previously, so it's just about weathering those storms. Secondly is to enjoy and capitalize on some of the equity. So I've had the privilege of buying a lot of fourplexes with Steve, 12 or so, and the first ones have appreciated several hundreds of thousands of dollars. And so last year, in the second half of last year, I took 4 of those, sold the fourplexes, capitalized on those returns, and then we're able to sell 1 fourplex, 1031 exchange into 2 brand new fourplexes as an equity play and go from 4 doors to 8 doors without any additional capital outlay. And so I've been really grateful for that. It's been an awesome experience. And then lastly is also diversifying a little bit outside of just the Utah market. So moving into Meridian, Texas, hopefully Arizona, and so.
Thanks. My name is Jim Holm. I'm the previous CEO of Performance Assessment Network, which was one of the leading providers of psychology tests to companies so that they can hire better. I knew nothing about real estate, but I did know that I needed to diversify what I did as an individual. And real estate became a really great way for me to be able to do that. I was able to do quite well over the last 8 years in working with FIG. And to me, when I look at the downturn, it's almost a certainty that it's coming. I work with 2 private equity groups right now. The first question in every company evaluation that we do is, what is the downside economic risk to making this investment? And we turn down very good deals because of economic risk. It has also increased the price of assets or companies that are deemed to be countercyclical or acyclical, or it's not going to be impacted. And so that's very interesting from a prediction over the next 2 to 3 years, what those private equity groups think is going to be happening. Personally, I'm excited about it because as a buy and hold investor over time, probably the most important thing to me that impacts the value for my portfolio is the interest rate. The lower the interest rate, the better the returns I'm going to be able to get over a longer period of time. And in an economic downturn, chances are there will be pressures to lower that interest rate, which then means I will have better investment returns as I move into retirement. So the key element is you have to be able to be prepared to take advantage of those interest rates with the liquidity and other things that have been mentioned before. But in my particular type of investment that I do, I actually would see it as a positive turn.
Good morning. My name is Randy Lupke, and I'm with Lifetime Paradigm. I am a registered financial consultant. To help you understand what that is, think of me as like a general practitioner in finance. So I basically do everything from life insurance, annuities, securities. As a fiduciary, I'm also a mortgage broker and a real estate broker. I don't file tax returns, and I'm not an attorney. Those are the two things I don't do. We think that a recession is, may be coming. The reality is it is going to happen. It's going to come. This white hair, this is 2008, right? I had brown hair up until then. So I saw it in 2008. Let me back up. So as a financial consultant, I'm constantly juggling my clients' assets and priorities based on things that are happening in their life. People are retiring, their kids are going to college, maybe somebody had a severe health change. So there's all types of things that happen in our lives individually that as my job I have to deal with. And when you have these big economic swings like 2008, I mean, that really literally handed a lot of people's head in a basket to them. But people like Mike Miller jumped in 2008 because he saw it as an amazing opportunity to make a lot of money. And he's absolutely right. Steve's absolutely right. When you have these downturns, that's when you can really take advantage of it. So the 2 words of advice I would say is just always remember the adage, cash is king, right? Because cash is what's going to carry you through and give you the money to take advantage of the opportunities that will be presented to you. And then the second thing is be agile, right? Be agile and flexible and open to anything. And maybe ideas like, the speaker last night, it was I forget the comments about the bulb, but he was so right on. So you have to be open to new ideas, new things, be agile, be flexible, and don't get yourself in a position where all your assets are tied up and they're illiquid, and you don't have cash to ride out the storm. That would be my advice.
Hi everyone, my name is Paul Mayfield, and I'll start by saying, if I could only have a thick, lush hair.
I'll give you some.
Single one, that's white, I don't care, that would be awesome. But yeah, I'm an individual investor. I would say the things that I've been thinking about in terms of my own, asset management is, well, first, for the past 2 or 3 years, thinking that a downturn could be coming, I have been allocating more into real estate, actually. And as I look at the real estate portfolio, I'm trying to keep the loan to values down. There's some refinancing that I may have done to pull equity, but I'm going to hold off doing that, just save the capital for a little bit later to make sure the expenses are sort of minimum on that portfolio. With the market exposure I have, taking more defensive positions, investment grade bonds, or paid up premiums whole life, that sort of thing. Just things that I think if I'm holding the bonds to maturity can survive pretty well through a downturn, so that when the upside starts to happen again, there's liquidity or there's access to capital to take advantage of it. But other than that, it's kind of the basic things we do to take a defensive strat. Oh, the one other thing is I'm personally thinking about where the taxes are going to go, a decade down the road. And, they're at pretty historic lows. And I even did something crazy that my friends thought was pretty stupid, which was I just took an early withdrawal on half the 529 accounts for my children that I had saved and just rolled it into real estate, because the growth portion, which was about half of what I took out, took a 10% fee, but when I ran the numbers, I felt like I could get the return in a pretty tax-efficient way out of real estate anyway and break even in a couple of years. And if I think down the road, taxes are going up, I understand that the 529s are earmarked to real estate, but as I start thinking about retirement accounts, everything else like that, I'm almost wondering if there's a better opportunity in the short term. So.
Hi, my name's Christina Wu. I normally don't sound like this, but I've been sick for the last week and a half, so my apologies for my voice. I'm a real estate investor as well as agent in the San Francisco Bay Area. Before becoming a real estate agent, I was a strategy consultant, was a Wall Street analyst, taught personal financial planning, and generally am a finance geek who loves staying up at night, looking at different scenarios, modeling different scenarios, and thinking about how to optimize my own portfolio so that I can enjoy my life with my family more than worrying about paying the bills. And I own a number of FIG investments, have a number of my clients invested in FIG investments. And it's tough to go at the end of this panel because so much insight has already been shared. But as a Wall Street analyst, I used to cover macroeconomic trends. And one thing that we would see is growth trends are great. They last 7 to 9 years, and periods of contraction are more like 3 to 5 years, but that's what's memorable, and it hits hard. So I think one of the other things that I'm doing, aside from what's been mentioned here, is to think about my financing on the investment properties that I have. So I'm a firm believer in adjustable rate mortgages. I'm not a buy and hold, going to keep these things for 30 years type of person. I want to cycle out of investments that I bought early stage before they took off, sell them at sort of their peak, but before they need some pretty big maintenance, and then buy into the next, newest community that's growing. And so from an investment perspective, if we believe we're at the somewhat beginning stages of a downturn, I'm looking more like at 7-year financing terms instead of like a 5. Some of my clients have been looking at 10-year financing terms, just so that you can weather the storm, your payments are really predictable, and then when the time is right, turn around and sell those assets.
Hola, my name is Matt Atkinson. So I get an idea for us with the panel. If you've been investing for less since 2011 or newer, since then, raise your hand. 2011, raise your hand high. Okay, if you invested before 2004, raise your hand high. And if you've been investing before 1998, raise your hand high. Okay, cool. So I just kind of shared 3 different cycles that if you weren't investing, you could go back and research. So I would suggest that. It's funny, as my name is Matt Atkinson, I'm a mortgage lender since the end of 2001. I've been investing since 2004, and I bought my first property actually in Orem, which I still own. And here's 3 things that I'm doing with the shift. I love what Dave shared. I actually met with him like 11 years ago when he was trying to buy like this triple net lease and all this extra money, and it's cool that he bought some properties and he's just rolling up. So here's 3 things that I would encourage you guys to do. Number 1 is I'm cashing out of properties I've owned for more than 10 years because the deferred maintenance and the management's eating me up. So I love the ARM options. The second thing is I have 6 months of expenses on all of my portfolio. So I'm not holding that in cash, but I lend out hard money in notes. It's an awesome way that you can get your money back quick. So I think I'm capitalizing and cashing out and actually going to pay the tax to offset last year and this year on properties I've owned since 2006. And then the third thing is that I think is really smart is rolling up. A lot of times people don't utilize that enough. So depending on what part of the market that you feel that you're in, I got to be honest, real estate is all about lifestyle. So it doesn't matter how many doors we have or how we're getting taxed or if we're buying this new development, but if you can complement your lifestyle and be able to do what you want to do, that's really what real estate's all about. So those are 3 things that I suggest. So having 6 months of living expenses for all of your real estate, utilizing notes. Number 2 is I'm cashing out, getting money right now. And then number 3 is I really love the ARM option. You made me think to go research that again as a mortgage lender. So those are some tips that I'm doing right now.
Awesome. Thank you. Pens should be flying or clacking if you're taking notes that way. Okay, so great news, an update. Tim Ballard will be here on time. So we are on schedule and everything is okay. That is really great in my world right now and yours. Okay, panelists, thank you. What a great start. So I made up a little game while I was up here with a dry erase marker and this piece of paper. So I'm going to start it. Panelists, first person to raise your hand gets to answer the question. Cool? And I want a hand raised. First off, what do you see as far as your predictions of supply versus demand in this market going forward the next year?
Utah market?
Mr. Miller.
Utah market?
Yeah, the Utah market specifically because it's too hard to go that broad with this audience right now.
For what we do, townhomes, I don't think we can build them fast enough. And I think that for the foreseeable future, if we can find land, I think there's going to always be a buyer.
Excellent. I love it. Okay, so here's another way to rephrase that question as well in a follow-up to anyone on the panel. Supply and demand, 2008 versus what you predict for 2019 in our real estate market. What's the difference of this correcting market supply and demand versus 2008 supply and demand? Matt Atkinson.
In 2008, you had a lot of people buy 100% financing, stated income loans, didn't have any reserves, because I gave them those loans. And then 12 months later, as the economy started getting worse, they became accidental landlords. So accidental landlords became landlords, and we bought their properties short sale subject to other things like that. I think because of the strengthening with lending, that's not going to happen again as much, because what you qualify for is what you qualify for. So I think that we won't have as big a gap. And then also on the rental side, I've got 91 rental properties here in Utah. If we market them correctly, we're turning them in 3 days. So the rental is super strong, and then the first time home buyer, there's even a bigger gap. So I just don't think it'll be as catastrophic unless something else happens that we don't think about.
Correct. I'm going to regurgitate a little bit about what you said that I definitely want to point driven home to anyone who hasn't totally clearly recognized this. The buyer in 2008 didn't ever have an intent to be a landlord or to live in the unit and did not have capital risk. It's a very different intent to investing than we see right now. The buyer today qualifies and has an intent to occupy or has an intent to be a landlord. Right away, off the bat, intent from beginning to end, action flows through. Their risk tolerance to a market correction is so much different because it stabilizes. It's simply the market doing its thing. It's not a complete collapse of people that were not qualified to be in the market in the first place. A very different reaction to this market trend as I see it. Any arguments?
So I think anytime you look at real estate is cyclical. It's going to go up and down with the economy. If you look at just macroeconomics and you start looking at numbers, job growth, okay, jobs report that came out yesterday, 322,000 new jobs, extremely healthy. The December report, extremely healthy. And if you look at this market as a whole, Utah, again, the job growth in this market has been a whole. And I would say any market you look at, it goes back to some of the points that were made in some of the other presentations. I attended Grant's presentation. He said, when you do student housing, underwrite the university. Absolutely brilliant. It's the same with real estate. If you look at a market, you got to underwrite what are the dynamics of the market. Is it a healthy, growing economy? And so this time is very different because last time there was this huge bubble that was all this subprime debt, and this time there's continued growth. And one of the things I would say is look for information that is generated from those markets. The Kim Gardner Institute here locally in Utah, they do a ton of research. There's a publicly available report. It's the 2019 Governor's Economic Projection. It just came out 2 weeks ago, and it's from probably the most well-respected research institute in the state of Utah. So they're going to have a lot of really good information. So I said, whatever market you're in, go find those sources of information.
Excellent. Okay. Oh, Grant, go ahead.
I was just going to add that I think the behavior of the capital markets is totally different right now than it was, 10 years ago or leading up to the last downturn. On our apartment deals and student housing deals, we're financing those, maybe 60 to 70% LTV. We're not seeing these crazy 85, 90, or 100 LTV loans. So I think that the banks have been pretty conservative and they want real skin in the game. They want cash into the deal. And the second thing is, from an investor perspective, it seems that people are focusing a lot more on just cash on cash returns, the fundamentals of the deal, holding it for the long term, with a huge focus on a cash flow versus just purely appreciation. So it feels very different.
Excellent, thank you. I need 3 volunteers for this one. Best real estate investment you've ever made, and why? 30 seconds, 3 hands. Randy Lupke, Christina Wu, Dave Allred.
Yeah. So this kind of ties in with the theme. The best real estate investment I ever made was actually my primary residence that I bought in Newport Beach, Coronel Del Mar. It's a little southern part of Newport Beach, just before Laguna Beach. And I bought it in 1993, and this is going back to your point before about 1998. I've been doing this for 32 years. 93 was another recession in real estate, a big recession in real estate. Back then, the savings and loans, which of course have gone the way of the dinosaur, all went out of business. And the savings and loans were all, assets were all taken over by the Resolution Trust Corporation, federal agency that took over basically the banks foreclosed, and then the Resolution Trust foreclosed on the savings and loans, right? That's how it worked. So I bought my house from the Resolution Trust. I tried to buy it from the buyer, but before the bank that foreclosed on it, but before I could buy it from the bank went into foreclosure. You following this? It's pretty crazy. So it took about a year and a half to actually finally get the deal closed. And I can remember I was standing at on a dock in Catalina Island with this funky cell phone, and my wife's talking to me, and I had to stand out at the dock so I could any kind of signal. And there were 3 people bidding on this house in this recession. Yeah. And I bought it for $625,000. And this now keep in mind that the house before this that I owned was like a $200,000 home. So this is like a big leap, right? Back in 1993. Bought the house, and it was kind of like, remember the show The Munsters? Do you remember that show, The Munsters? And everything was just like gross and falling apart. This house had a swimming pool that was solid green. It had bushes coming out of the kitchen. It was amazingly awful. It was a perfect house to buy, right? So we bought it, we fixed it up, we moved into it. We lived in it for 13 years. I sold it for $2.3 million. And that was the best real estate investment I ever made. And I got to live in it for 13 years to boot.
Thank you. Okay. Christina Wu.
I'm tempted to say fig,
You can.
but I won't.
She said fig.
Fig has been really good, but you said singular investment, and I have so many fig investments that I feel like it doesn't lend to the spirit of the question. So mine is actually, I'm from California, from the Bay Area, remember? So this is going to blow many of your minds. There was a brand new construction, 4-bedroom, 3-bathroom, 1,700 square foot townhouse at the steal of a price of $1 million in 2014. Wow, not the reaction I was thinking. I was thinking, wait, what? And I saw this posted. The listing agent wasn't doing it any favors because they said, drive by before even bothering to call me. So I did.
Are they still in business?
Well, it was the developer. Can you imagine? So I drove by, and it's 1 unit out of 6 through an up and coming area of Mountain View, California. Half a block away was a trailer park. Nothing against trailer parks, but it was right there. And on that same block were a bunch of condemned homes. And so I could see how that neighborhood was not great. But it was walking distance to Google Quad. And that's really meaningful because that means, a lot of people can just walk to their very high-paying jobs. And then I researched, well, what's going in here? There are all these fences and all these signs, don't trespass. There were going to be luxury townhouses built right there. All 3-level. The townhouse we ended up buying was 2-level. And so I am so thankful that my husband just trusts my instincts because we really had nothing to go on except a floor plan, a warning from an agent to drive before you even bother calling. And we made an offer on this property, bought it, moved into it, and this was in June of 2014. My family and I stayed there for 2 years and had a wonderful experience living there, made good friends as our neighbors. Sure enough, the luxury townhouses were built around there. The entire neighborhood was cleaned up. I sold this property last year for $1.85 million. Bought it in 2014. Because my husband and I lived there with our family for 2 years, we took $500,000 of capital gains, tax-free, put that in our pockets, actually put that into FIG.
Thank you.
And we did a hybrid. So for the other $300,000 that remained, we actually did 1031 exchange into 5 separate FIG investments. So for those of you who are interested in ways of creating value, you can really do so with your primary residence because of some of the tax advantages of owning real estate and being able to do this hybrid 1031 exchange while taking the $500,000.
Thank you. Thank you very much. All right, Dave Allred.
So greatest investment would be last year when I bought a few Bitcoins, and just kidding. That was.
Do you see
didn't
the
go
doors at the
very
back?
well.
Just kidding. Go ahead.
I would actually say, I'm going to go ahead and say FIG with the 12 fourplexes that I've purchased from these guys, specifically the ones that I first started off with about 5 years ago. And, I bought 3 of these fourplexes, and, and the cash flow has been a couple things. One, I always have a goal of keeping a lever ratio of around 60% max, just to be relatively conservative. And one thing I've enjoyed is I put 25% down on a fourplex, but by the time it's completed, which takes a little while sometimes, but there's actually that built-in equity where it's close to about a 60% loan to cost, and so loan to value. And so that's been really, really fun. The cash flow's been amazing along the way. As all the tax depreciation, tax benefits that help offset the other income that I make outside of my real estate ventures is very beneficial as well. And then on top of that, with having cost segregation, with having Corey managing it is phenomenal on the property management side. And then to be able to 1031 those, and be able to go into other projects like a Vasa gym and some commercial stuff, and one of these 20 plexes that we're working on, and to be able to go and sell one and then multiply that into 2 new fourplexes without any extra capital. That's been really fun for me. It's something that it's creating real value. It's tangible. It's a pretty simple model, so it's not a crazy cool story, but it's just it's been a really good rate of return for me and something I really enjoyed. I've been laser focused for the last 10 years on getting a passive income to be able to have true financial, have our cost of living covered, and that's truly is financial freedom. I think that's something it's a great position to be in, and so for me, I've had a lot of little speculative investments that have been fun, but when it comes down to like good, stable, more conservative, conventional investments, I'd have to say fourplexes. So
Awesome. Thank you.
you can
Matt
buy
Atkinson.
me lunch later.
I bought a property in 2009 in Ogden, Utah for $32,000. I sold it so that's my best one. I sold it in 2015 for $65,000. I did a reverse exchange and a traditional exchange. I bought a fourplex, a duplex, and a single-family residency, all seller financing for $650,000 from that sale. I pulled comps on it last month for a presentation for some other organization, and it's worth $1.3 million here in Salt Lake. The rent when I bought it in 2009 was $625 a month in Ogden. The gross rent now on the fourplex, the duplex, and the single is $9,000 a month. How I would have made that better, knowing what I would have known now, is I would have bought it in a Roth IRA. So,
Nice. Excellent.
a lot
Thank
of
you
cool
very
things.
much.
Yep.
Thank you. Okay, so I have a quick follow-up. So Dave Allred said laser focus, and there's let me just give a little bit of light on that. Dave will come when he wants to buy, and multiple investors in here that have come, they come with their spreadsheets of exactly what they want to have achieved. And then they'll grab a sales agent, corner us in a room, tie us up, and say, tell me exactly how you're going to get me my goals. It's pretty close to that, right, Dave? And that's actually really invigorating because that's an educated investor. That's someone who has an action plan. They will act and go, and they will do it if you just give them the green lights of how. And so if there's a takeaway, a lot of these people just talked about something they did. You had a plan, you executed and did it. And real estate investing is exactly that. So I have one last question before it's opened up to everyone here. And two people, favorite or most inspiring book? Allred.
Not really centered around real estate, but Extreme Ownership by Jocko Willink, Navy SEALs, SEAL Team 6. Really good. Actually, I think I shared that recommendation with a few people in the room, and it's been mandatory reading for all my leadership teams, and yeah, so that's one. I'm going to go on the top 20 here.
I know you have it. No, next person. Thank you. Paul.
So my favorite book tends to be the most recent one I've read, and the one that has inspired me. Actually, the one I'm reading now, I think, is really, really good if folks are looking for something interesting, which is Ray Dalio's Big Debt Crises. I mentioned this in my presentation earlier. But he has this fantastic, Ray Dalio's the founding partner of Bridgewater Capital, the largest hedge fund. And he has this fantastic sort of analysis. He has a 30-minute video you can see on YouTube, too, I'd recommend, that talks about how macroeconomics work, basically. He talks about a 75-year debt cycle that is created out of the use of credit in the economy and how it is mechanical and predictable and leads to even things like populism because credit extends the value of assets that the wealthy hold but not the working class. Anyway, fascinating book if you want to have some food for thought on how to think about the next 10 and 20 years. Ray thinks we're in a similar place as 1937. Lots of people are debating that online, but it's really, really interesting book.
Excellent. Okay, we're going to open up the floor to everyone out here. Thank you so much, panel. Be ready. They're going to fire some great questions. Now, how this will work, you raise your hand. You say your question. I restate your question because our recording team needs to hear it go through the mic system so that we can have this in your recording that you have later on. So, hands fly to the air. What questions are in the room? For Mr. Miller, you said you're in 3 markets. You say you're going into 5. Floor's yours.
So we're in Utah, the Salt Lake Metro, Boise, Idaho, Houston, Texas. We'll be in Phoenix, Metro, and Dallas by the end of the year.
Next, Matt Atkinson.
This question's for Randy. Knowing what you know now, what are 3 things you would have done differently if you started all over?
Yeah, that's a great question to ask somebody that's 66 years old. Yeah, because you know the expression, if you only knew now, or know then what you know now, and now I have no excuse because I do know it, right? You know, real estate has always been a part of me. You know, I think back, I don't want to go on too long with this, but I think it's a good story, but my father passed away when I was about 2.5 years old. Had a heart attack, and my mother raised my sister and I, didn't remarry, and she raised us because we had 2 rental properties that provided the income for her, so she didn't have to get a job. And with a little life insurance policy and that real estate, you know, my mom was able to take care of us our whole life. And I think it had a big effect on me in terms of, you know, realizing the value of real estate and what it can do. So if I could do just one thing all over again, I would have started acquiring more real estate younger and held on to it longer, and I would just continue to do that because you know, this is, I know I'm strange. I'm a financial advisor. I'm a fiduciary. I have $20 million of my clients' money in the stock market, and I wish it wasn't there. Right, I wish it was in other places, but it needs to be there because we have to have diversification too. But real estate is this kind of magic product that does all kinds of things for all kinds of people in a lot of different ways. And that's why I'm such a big advocate for it. And I guess that's why I'm here, huh?
Yeah.
Even being a
Thank you.
stockbroker. So.
Thank you very much. Any other questions?
So I'm wondering, is there a general rule of thumb that you feel comfortable with how quickly you get out of a property? Because if it's producing well for you, and I realize there'll be maintenance requests eventually, but how long can you keep in a property before you feel like you need to 1031 it?
My personal opinion is it all depends on what your individual long-term goals are. right? If it's passive income, if it's more just accumulation of you know, of wealth. And so for me, when I first got started, it was all long term. I thought I was going to hold on to everything, and it was my retirement fund, and it was all very, very long term. Since then, that's evolved a little bit where I want to hold some of it long term, but I also want to be able to pivot and to be able to take advantage of the market and to be able to, you know, to be able to be agile and move and really have more of an equity play with more doors. And so, and I love what you mentioned about having some of your loans be short term. The more recent fourplexes I'm buying, I'm doing, you know, some of them are 30, some of them are 10 years, some are 7-year arms, just so that I have a mix, and I can kind of take advantage of those the timing in the market. But I really, you know, as a takeaway, I've never really looked at it as a really short term thing of just like 5 years. But in my personal, the way I'm operating is I want to be able to have all options available at all times. So I don't think there's necessarily a fixed, this is the right way of doing it. I think we need to be able to be flexible, pivot. And secondly, is it depends on what your long-term goals are.
Awesome. Thank you.
Can I add to that? Can I just make a quick comment?
Yeah, go ahead, Randy.
Yeah,
Well, I'm walking
just a
over.
quick one-liner. I mean, my philosophy has always been buy a property with the intention that you'll hold it forever, but be willing to sell it any time, right? And that way, you know, you have something you want and it's worth keeping. But you know, if the opportunity comes along or the need to sell it, you're not married to it. And you're willing to sell it any time.
So if you're getting started right now, what would be your first investment that you would do?
Mike just gave me the answer, and it was fourplexes. But the trick he didn't know is that's what I was going to answer. My first real estate investment was a fourplex. It was a fourplex built in 1943, obviously long before I was born. I think that it gave me the experience. I was doing property management, I was doing maintenance, I was doing everything. And so being that involved in the property, it gave you a real life view of what it takes to be in real estate. Because as you grow your real estate portfolio, at some point you're not going to be doing the maintenance. And at some point you're not going to be doing the property management. And at some point, you're not going to be doing the different aspects of it. But yet, if you know how each of those aspects work, then you know the pitfalls that can happen there. And so, for me, that on-the-job learning is the best way. So, you know, for my kids, if they made their very first real estate investment, I want them to be mowing the lawn of that thing. I want them to be collecting the rents. I want them to be dealing with the tenants, and because it just gets you involved, and then you're able to identify quality providers when you move up to the level you guys are at, and the people that do a good job of providing either quality construction, quality property management, quality asset management, whatever it is, you can see the differentiation, and those groups will be successful like what FIG has done. They blew up because they did a quality job of those different aspects. That work, Mike? Perfect. Okay.
We got our last question right here.
Hi. Do any of you feel like you're too heavily invested in Utah? Like I know, Christina, you're from California, and you talked about investing all of your money or the profits that you made into Utah. Do you have plans for investing outside in a different city, perhaps, or?
Do you have some specifics?
No.
She wants to call you out. Which one?
No, just like
No?
maybe Christina, and then like Dave, you mentioned that you have like 12 fourplexes in Utah, and just wondering like if you guys are planning to expand outside of Utah or.
So, yes, I have investments in Idaho as well through Fourplex Investment Group, investments in other states through other vehicles. But to say I have all this tied up in Utah, well, that's true. I have properties, though, in Harriman, in American Fork, in Eagle Mountain, and these are all very different areas, different dynamics within the great state of Utah. So I actually feel very diversified, still taking advantage. Like when I first met my husband, I would say, go big or go home. Like, he would want to buy, 10 shares of a stock. And I'm thinking, it's not even worth the transaction fee. Like, if you've done the work and you feel really good about an investment thesis, put some real money behind it. None of this 10 share stuff. And so I feel like I did a lot of the work on Utah, really like it, but I still have the diversification of being present in different locations and submarkets within Utah, and that gives me comfort while still feeling like I'm going to do well with my investments.
That's a great answer. I think so. I started out only in Utah, and I think Utah's economics look phenomenal. I think every data point right now in Utah continues to look really, really strong. So I don't have any concerns with only being in Utah. However, my recent acquisitions are in Meridian and Texas, and so I did want to expand a little bit out of Utah. I think that, but I've also lived in the Bay Area for 2 years, just a few years back, and in Colorado. And I see a lot of investor capital coming into the state of Utah, which is an indicator of where, people in California want to invest here because, why? Because the economics are better, the returns are better, substantially. And so I think it goes back to the point of just research the general, on a macroeconomics of the market, the state, and, but I don't think there's necessarily a right or a wrong. I think it just comes back to your personal preference. And a lot of people like to be more involved, and to be able to walk the property and to be able to, drive by it and see it. Originally, I was thinking that was more of my mindset. Now I have enough trust in Corey and the property management side of FIG that I feel like I can be pretty hands-off and expand outside of Utah. So,
awesome. Thank you. Let's give him a round of applause. Thank you, panel.